All right, here we are, 1st of June, and I am at my corporate office in Henderson. So this is our basically our recording room. So this is where I kind of house myself while I'm here because I'm on a lot of Zooms doing things that gives a little bit better background than the regular office thing, especially what I have on a daily basis. But, of course, always, if you don't have it, grab it. It's a bit of a whoop in the ass to get you moving forward to where you want to go. You get to determine where you want to go. You get to determine what is success in your world. And when you're talking about real estate investing, it needs to be defined properly. And I think a lot of people are defining about what other people tell them. And a lot of things people are talking about is cash on cash return. And in today's environment, it's hard to be successful with that being your sole metric. So we need to talk a little bit about it more, get into the depths of it so you understand what's a successful real estate investing business for you. And this will help you get there. Because it's not about the real estate itself. It's not about the strategies. That's what you got me for, the strategies and all that stuff when it comes to building out your business, entity structuring, how to set your baselines, where you want to dig your foundation to bedrock to be able to protect your family and build your wealth. But this is where the mindset comes from. You need the mindset piece of it. So I'm not going to beleaguer that, but check it out. If you haven't, come on, let's check it out. And maybe all of you that are watching this, because again, there's only a handful of people to watch this. I'm only giving you data that helps you, the real estate investor, making decisions today. So let's talk about the market so you can see exactly what's happening out there and what we are looking at. So Friday, we had some good information that was helping the bonds go in, and everybody who was buying into the bonds wanted to jump into this and start making things happen. So you had a bit of a rally. But where did it rally to, right? We were talking about that on Friday. It rallied to right at that level we talked about where they announced quantitative easing, hit that bounce right off of that. Then there was concerns with respect to what's going on overseas. Everything is being driven by what's happening with inflation. So inflation worries with respect to what's going on in the Straits and what's going on with Iran. Then we saw that swing downward. And where did it touch? Our channel. Hit there, bounced off of that, pulled back up, and it's above a line that we'd set. I don't even know when I set this. This floor, which has been acting as a ceiling. I haven't been changing these colors like I should. Red if it's acting as a ceiling, blue if it's acting as a floor. But here we are today. We opened up pretty close to where we closed on Friday, and we're going back down negative. Now it's because there's still concerns of what's happening over in the overseas. What's driving all these things? Of course, Friday we had there was optimism, lower yields. There were some cooling concerns as far as the geopolitical stuff, less fear for the energy-driven inflation, lower treasury yields, more willingness to own fixed income instruments, which is what this is, right? So because of the investors kind of thinking, at least the thought process, if inflation risk is falling, they don't need as much yield to buy into the bonds, and they have that flat rate of return. Monday opens up with what was going on over the weekend, and the bond market's questioning, is inflation really improving? Will energy prices rise again? Will the Fed stay higher for longer? So that kind of pushed us into a negative spot. But now we got today where it seems like inflation is truly sticky, right? And if it is going to be that, investors are going to demand that higher yield. Mortgage prices are going to fall. Mortgage rates will rise. Employment data is coming out this week. That always has some effect, but not as much as what's happening overseas. So you might see some lower yields with that weakening labor market, better pricing of the MBS if we have a weakening labor market. But these energy prices, they will continue to stick and continue to stick. Now, most people think, you as a real estate investor might be thinking, when you lock the rate, you're negotiating with me or another bank and trying to pit banks against each other. That's not what's happening. You're stepping basically onto the trading floor of the largest financial markets of the world. Your mortgage is going to be part of a mortgage-backed security. It's going to be bundled together. That means somewhere there's an investor out there saying, how much return do I need to put up the money for you to buy this home? And the rate you lock, that's the answer. That's what they need to be able to get a return. That's what their risk level for them to get that flat rate of return makes them feel more apt to give you that capital, right? So this last week, good example. Friday, the bonds improved because investors believe that inflation pressure may ease and money move back into that fixed income type of instrument, which is your mortgage-backed security and other bonds. So when they buy those bonds, those prices rise, the required yields will fall, and mortgage rates will improve a bit. But when fear returns into the market, which is what we kind of saw yesterday morning, inflation concerns will rise, investors demand more money, more return, mortgage rates are going to go up to provide that return. So you, as the real estate investor, are entering into the same trade, but from an opposite side as a bond trader. They're buying your payment stream. You're locking in your cost of capital for 30 years. They want the highest yield possible in that payment stream, but you want the lowest cost of that money possible. And that's the day you lock your loan, is what's going to give me the best payment I can anticipate for the next 30 years based upon the information that's in front of me. And they're saying, what's the best return I can get on my investment I'm putting out? I'm going to wait 30 years to get back. So you're both securing something for 30 years. They're securing a return. You're securing a low price. So when you think about this, don't just ask, what's my rate? Say, what's happening in the market that's going to determine my rate? And in that determination is now the right time to pull that trigger. As far as I'm concerned, if you've got a property and keep reasonably rented the entire time you own it, you're able to raise rents on it, it appreciates, and somebody else pays off that mortgage, anytime's a good time, especially if it's cash flowing and you can raise the rents. It's going to compound that cash flow. But we need to talk a little bit more about that. We need to understand those baselines. You and I got to talk and get that figured out, so you know what is success to you and you have the emphasis to drive you to get it done. So appreciate you guys, and I will talk to you on Friday.